There's a lot we need to talk about in terms of the markets with our next guest. David Kostin is the chief equity strategist at Goldman Sachs. He has had a year-end S&P target of 2,100. That is the lowest of any strategist surveyed by Bloomberg. David, welcome. You may be in good company. I'm looking at the headline crossing right now. Bill Gross of Janus now is saying the good times are over for many markets in 2015. Do you agree?
Well, I think the trajectory of the U.S. equity market for this year is likely to see a lower trajectory at the beginning of the year. We can see a rise towards the middle part of the year and a fade at the end of the year. And if I kind of went through each of those items, right now the sentiment indicator that we use, looking at futures positioning data, is at an extreme of 100. It's been there for basically the past month. And that would suggest over the next 4 to 6 weeks, we would look for a pullback in the market. In fact, that is what we've seen already at the very beginning of this year, something in order of 2 to 4% over that period of time. So that's a near-term tactical positioning in the market likely to go lower. If you look at the broad trajectory, you mentioned some of the ISM data. Basically, the economy is growing. In our view, the economy is growing at over 3% for this year, and earnings will be rising. And as a result of that, anticipate the market basically moving higher to the middle part of the year. And then as we look towards the latter half of 2015, we'll have the Fed hike. And as a result of that, likely to get a PE compression. At the end of the day, you end at a 2,100 level, which is only modestly above that, looking at roughly 5% total return, including dividends.
David, why now? Why does the argument that the rally is running out of steam now make sense versus 12 months ago? Because if you'll recall, at the beginning of 2014, we could have had a similar conversation. At the time, we were talking about the difficulty that many companies in the S&P 500, large cap stocks, would have improving margins, for example, and we were questioning whether investors would be prepared to pay a higher multiple for stocks. As it turned out, both happened somewhat contrary to expectations. Not necessarily yours, because I know you felt as though there was still some room for margin expansion, but there's always that question of multiples.
So if you think about the key issue in response to your question, what is different this time, or what is a unique situation, is we are trading, the overall S&P 500 is trading at just about 18 times forward PE on the median stock, the typical company, and it's only been at that level or above basically 2% of the time in the last 40 years.
Why? What is it doing?
So the typical PE multiple is lower.
So we're at max valuation.
We're starting at a valuation which was extremely high. And typically what happens in a PE multiple expansion phase, which we've had now for the last several years, is an environment where interest rates are falling and inflation is falling. And as we look forward into 2015, likelihood is, our view at Goldman Sachs is that the interest rates will likely go a little bit higher, and inflation, while not a major concern, will be moving higher, not lower. So those two dynamics would suggest that PE multiple expansion phase of the market is behind us. And so now we're really limiting ourselves to a growth in the economy, earnings, sales, more traditional drivers, as opposed to PE expansion. The PE expansion is what gets to the extraordinary returns. And, of course, the PEs have gone from around 10.5 times to, as I said, close to 18 times as a median stock. The typical company is very expensive.
Then do you think tech valuations could get hit the most? I mean, those are the ones that really have blown out.
So if you think about the positioning inside the market, technology offers the best growth in the market. That's an area to focus on. Within a limited amount of growth, that is at an extreme. And if you look at the best value in the market, it's energy and telecom. Those are the two areas, so growth and value as strategies looking into 2015 that we would recommend.
What about the, I wouldn't call it the argument, but the observation that's been made repeatedly over the past few weeks that the Fed tightening monetary policy is a good sign, and it's usually at times of monetary tightening that stocks tend to keep going higher?
Well, traditionally the reflection is the economy, the central
economy is improving.
Is tightening because the economy is getting better. And in fact, the economy is getting better. In the United States, that's a positive situation. The U.S. economy is growing over 3% this year, and our forecast it'll grow more than 3% for several years. And as a result, that lifts sales. And even if margins stay flat, which is my forecast, you basically get earnings growth in the market, and that's essentially how you get a higher stock market over the next year and 2 years, although it's a more modest trajectory than we've experienced in the last couple of years.
What do you see then happening in 2016?
So if we go out over a multi-year period of time, the economy is growing. over 3%, and the market is basically going to be climbing, in my forecast. 2100, 22, 2300 is the trajectory you should think about for 2014, 15, 16, and 17. Next couple of years, that's the kind of return, a roughly 6% annualized total return, including dividends, and that's not that different from what is a long-term trajectory.
What about some of these more wild card variables like oil prices and the U.S. dollar?
All right, so oil prices, a huge focus for obvious reasons. Oil prices down 50%, round numbers in 6 months, and that's been a big issue. Our analysis and our models would suggest that a lower oil price is actually a positive for overall earnings. Lower oil price is a positive for the broad market. So we have a discrete and reasonably identifiable negative impact on energy companies that we understand, but it is more diffuse in terms of the impact, positive impact in terms of the consumer, has lower gasoline prices, offer more discretionary spending, number one. Number two, it's a lower input cost for many other corporations. Think about airlines or the trucking industry, where they have benefits. So there is, on the negative side, and there's a positive side, and overall, lower oil prices leads to faster GDP growth, and that's a positive statement for sales and overall in the market.
You had said you think margins will be flat. Why is that?
Well, companies have been looking to try to improve and widen their margins. Margins have been sitting at this level today for the last 4 years. They have been hovering just around 9%, 2011, 12, 13, 14. Now we're in the early part of 2015. Companies have taken as much, they've tried to take as much cost out of their system, and margins have been very high. That's a positive, but they've been hovering at these levels. And our models would suggest that we're likely to stay around these levels for the next couple of years.
Now let's talk about the dollar.
Yeah.
Dollar hasn't been this high. I could chart it in a second, but it hasn't been this high for a long time. People have been used to, so I mean, I don't need to explain the relationship to everybody. Cheap U.S. dollar obviously makes it cheaper for American companies to export goods. Cheap euro, which is what we have now, puts American companies at the very least at a disadvantage versus the Europeans.
So the actual impact of the dollar is relatively more modest in the overall market than is commonly perceived. And the reason for that is 2/3 of revenues of U.S. corporations are domestic. So many companies, many industries are actually highly domestic, and therefore the dollar is really of relatively tangential importance. On the other hand, there are some industries where exporters are very, very important. And it would explains the argument of why investors should own U.S. corporations that are more domestically facing. It could be in any industry, but you want to be domestically facing.
Like, give an example.
Well, it could be
utilities.
It could be any, utilities are a specific industry, but it could be any industry. Companies where there are Paychex, example. It's a company that generates 100% of its revenues domestically.
I didn't hear what you said.
Paychex.
Got it.
As an example. And the issue would be that those companies have both a price and a volume tailwind for better performance. The U.S. economy is growing over 3%. We have a European economy or Japanese economy growing at less than 1%, so that's a volume story. And then the price story is it's more competitive, as you made the observation, Eric, that exporters are more challenged in terms of the stronger dollar. So we want to basically be more domestically facing, and we want to have more any company with more U.S.-oriented revenues. Again, the bottom line is the U.S. economy is growing at 3%. That's the driver. The driver sales, and that's the key driver in this market, as opposed to a PE expansion story.
Now, is that relationship fully reflected in current prices?
The market trades roughly around a fair value, and therefore the trajectory in terms of faster, the rising market would be a function of.
I guess the question I'm trying to ask is: have people priced in a stronger dollar trajectory? And let's go back to oil prices for a moment. Has the decline to $48.50, which is more or less where we are today at WTI, been fully priced into energy?
A broad consensus view of most portfolio managers is that the dollar will continue to strengthen, the euro will weaken, the yen will weaken. That is a sort of, if you were looking for a singular consensus view, that would be held by many people, including myself. And I would say the oil price has been obviously highly volatile, and I think the market has moved more towards focusing on what are the implications for other industries and other sectors in the market. And Goldman Sachs' view is oil prices continue to be highly volatile.
But what does that
Are
say?
they volatile, or are they just going in one direction at this point, and we need to trade around it?
Well, from the perspective of owning U.S. companies that are less focused on, for example, you look at refiners. Refiners actually benefit. There are some industries, even within energy, that actually are beneficiaries of a lower oil price.
But broadly speaking, with the sell-off that we've seen in energy-related stocks since, at the very least, since November the 27th and before that, is energy undervalued right now? Overvalued? Is it a buy? Is it a sell? Is it a hold?
I believe if you look at a 12-month horizon, I think energy is among the more attractive places to be in the market. I think tech offers you the best growth. Technology stocks offer the best growth in the market.
Even given where valuations are.
Absolutely. And then we look at the energy and telecom offering better value. And those sort of two ways of attacking a market that trades at around fair value. We need either better growth or better value.
We have to take a break.
Entry points.
We do?
Yes.
We're talking to David Kostin. He's the chief equity strategist at Goldman Sachs. David, the question I was going to ask you before the break is, to what degree is your view that energy stocks offer value predicated on a recovery in oil prices, or is it purely a valuations call?
It's primarily a valuation. Relative to historical metrics, it's extremely attractively valued.
Effectively,
and the idea
so oversold.
That the companies that are likely to be cutting back on their capital spending and probably return more cash to shareholders. Within the energy sector, there's lots of different pockets. Refiners in particular are beneficiaries of lower oil prices. In other cases, they're more E&P companies more challenged in this environment. So within the market, we're looking for pockets of opportunity where there are either more growth or more value in a world where the U.S. stock market trades around a fair value, in my opinion.
How heavily invested are professional investors right now? Are they super long the market? Are they sitting in cash? Just give us an idea of how the year is starting to look.
Based on my conversations, most people ended the year pretty fully invested. In fact, our sentiment indicator would suggest that in the futures market, for example, people are positioned in a very sort of long way relative to how they've been in the last year. And that is the reason why I anticipate over the next month the market is likely to be weaker as a result of the fact that it's sort of an extreme. We're at an extreme, and that suggests, historically speaking, you're likely to get a lower market in the next month.
Could that have to do with the fact that many investors were playing catch-up, especially in November, December, when the market was doing so well, and people were suddenly buying because they didn't want to end the year below the indices?
Well, you saw a market move 10% since October, and so that would certainly suggest that people were looking to chase that performance.
How about hedge funds? Speaking of professional investors, I know you do a lot of research, David, into particularly hedge fund trades within the world of large cap equities. And we've spent some time talking about crowded trades. Do crowded trades explain why equity hedge funds on the whole did so poorly in 2014?
Well, the analysis we've shown for now almost 15 years is that on the long side, stock selection, hedge funds do a great job. We have a Bloomberg basket. In fact, we trade this. Our hedge fund VIP, very important position list, that consistently beats the market 2/3 of the time over the last 15 years.
Walk us through exactly what that is, in case our audience
what we're looking at is the positioning as reported to the SEC every 90 days. We've been looking at this since 2001, so we have a significant amount of data, and rolling that every 90 days, looking at the positions that are most frequently held in the top 10 positions. So basically the stocks that matter most to the performance of hedge funds. That is the analysis, and that's how we construct it. And 2/3 of the time in the last 15 years, that has been a outperformance by roughly a good amount, probably 300 basis points per year on average for the 15 years. So that would suggest on the long side, hedge funds have and continue to do well. On the short side, unfortunately, it's been a little more difficult. If I was to, diagnostically try to identify what was not so successful in 2014, it's the idea that $1 out of $5 in hedge fund net exposure is in the consumer discretionary space. I know you're going to the Consumer Electronics Show, but that's the consumer space, and that was among one of the weaker performing sectors of the market last year. So that net exposure in consumer space would be a sort of a number one explanation for why.
What trends do you see playing out right now in hedge fund position taking in equities?
So the idea of looking for better growth. People are looking around where is those opportunities for growth in a market that the economy is growing more, still growing, but where growth in Europe and growth in Japan have weakened significantly. So more domestic exposure, a lot of questions about that. Looking for companies that are returning cash to shareholders, whether it's dividends and buybacks as a strategy. Is that a area to be exploited or identified? Some individual companies in those areas would be, I'd say, two big areas. Risk adjusted. People are looking for a risk adjusted approach where the uncertainty in a lot of markets is pretty high. Again, I come back to the initial point that the PE multiple, the median stock trades at almost 18 times forward earnings. It's traded there only 2% of the time in the last 40 years. So the market is highly valued. The idea is to find some opportunities, either better growth or better value in this kind of market.
But isn't it difficult to listen to that, to believe it, but to also be cautious when you look how far the markets run? Like, yes, the multiples are high, but they just seem to go higher.
I think if I look out this year with the idea of the Fed likely to raise rates later this year, inflation moving a little higher, those would be consistent with environments where PEs contract as opposed to PEs continue to expand.
So to the point I think Stephanie's making, what would you say, David, are the biggest risks to your outlook when you see the S&P 500 ending this year at 2,100, next year at 2,200, and so on?
From a central bank perspective, what's happening in Europe, a lot of questions over there, questions in Japan, questions in the U.S., whether the central bank policies can be implemented without too much dislocation. And the view here in the U.S. that will happen in the sense that it will go smoothly. The Fed has been very clear in sort of telegraphing its expectations. I think the market is anticipating a Fed hike. So I think that would be a risk to your saying if that was not to happen. I would say that's sort of would be sort of at the top of my list.
Here's a better way to ask it. Maybe. Do you feel better about your forecast today, this year, than you did at the beginning of 2014?
I think the starting point is a higher, and therefore the valuation is a headwind. I think you get a modest return this year, and I think a year ago it was still a better and faster earnings growth trajectory. Right now, the trajectory of earnings is about 5% growth in the coming year. A year ago it was faster, and so that would suggest a year ago we had better opportunities. Now with slower growth, not quite as good.
Then right now, you came back to work yesterday. What's the most common call you're getting? What are people asking you?
Questions relate to oil. It's probably the top of the list. I mean, it's the top of the story.
David, thank you so very much. Always great having you here.
Much.
David Kostin, he is the Chief Equity Strategist at Goldman Sachs.